A very good afternoon. You're watching the newsroom right here on ETNow. I'm Ajaya Sharma. It is the monthly expiry day, so some volatility is expected in the last hour of trade, but largely 17,500 or thereabout is what is contained. Broader market activity has picked up in the last couple of days, and today is no different. Advanced decline is showing the same kind of picture. Sahil Kapoor is joining us today from DSP to give us a view on markets from a strategist view, from an economist view, how to join the dots and what to make of equities that, like he always does. Sahil, good afternoon. Thank you so much for your time. Let's start our
Thank
chat
you
with the
again.
most worrying factor, which has been, the most worrying factor last couple of days, which is crude oil. Now, we all know what crude oil can do to economy like India, highly dependent on it. In fact, it has, it obviously, the trickle-down effect is making equities uncomfortable. It may have
Right.
come down from the levels of 130 odd, but the factors behind it. How are you analyzing the factors behind it to give for our viewers to understand possible direction it could take in the next couple of months? Factors like inventory levels, factors like the premium which is already built in, and
Right.
now that the kind of escalation is going down, do you expect all of that to unwind, to normalize?
Sure. So, Ajay, one parallel that we can go back in history and then come back to numbers is September 2019. We saw an attack on Saudi Arabian facilities, and it removed nearly 5 million barrels of oil a day for at least for a few days. And markets did not go into kind of a tailspin that they have gone now, because the underlying difference is at that point the markets were, flooded with oil. We were sitting in an oil glut. So you pointed the inventory levels. The OECD inventory levels at that time were at near all-time highs. Today they are at a 8-year low. I think that is a big difference between the oil market then and oil market now. What are the numbers that the markets are worried about? So if you look at the overall oil demand, it's sitting at about 99 to 100 million barrels per day, with the largest producer, US, at producing 11.6 million barrels per day for the last few weeks. And the second largest producer, Russia, producing about 11 million barrels per day. And then there is Saudi Arabia producing around 10.5, and then there is others. So these big three account for nearly 30% of the, or nearly 33% of the overall market supply globally. And when the second largest producer, when you talk about Russia, at 11 million barrels or 10.5 million barrels, it exports about 7 million barrels per day. And the market is trying to ascertain how much of that 7 million barrels is going to go away from the market. As things stand today, all the oil and gas which flows through pipelines is still going on. Those exports have not stopped. What has stopped is, oil and gas flowing through high seas. So that is the big problem. Sitting today, the markets are reading that around 2 million barrels per day of Russian oil will be off starting April. So that is a worrying factor, because oil market is a very, very sensitive market. Demand and supply equations are nearly balanced all the time. Where will the market find this additional 2 million barrels is the question. Today morning, US announced additional 1 million barrel per day of reserves supply. So they are going to, put reserves, their oil reserves back into the market at the rate of 1 million barrels a day. So that will, balance out some part of it. Where will we get the other balance from is what the market is trying to ascertain. And if you draw a parallel between history and today, whenever we've seen a very, very heightened geopolitical issue, whether it was the Iran-Iraq war or the Kuwait invasion of Iraq in 90s, and many such other smaller instances that we've seen, oil prices have spiked 4, 5, 6 times. But this time the spike is not so much, because markets knows that there are very large producers. Just one data point I'll share: US, which used to import 60% of its oil and gas in 2018, 2007, 2008, import zero today. It is a net exporter today. It will be a net exporter in 2023. So the biggest consumer is out of the market. And that's why I think the market has reacted a little lesser. Once the market finds out where this additional million barrel or 2 million barrel is going to come from, the market will cool off. And I think the signs are already there. Probably in the next few weeks or months, we'll see prices going back to pre-conflict levels.
Sure. Markets are already, in fact, have gone back to pre-conflict levels. Many markets are 10 to 20% higher than pre-conflict levels. We have just crawled
Right.
above that. Uh,
Right.
what are you making outlook on equities? Let's talk about emerging
Sure.
market as a whole now. They've been punished quite a lot and have come on the lower range, including India. What are your thoughts on that? And also have been taking the drubbing of the FI outflows.
Sure. So emerging market as a basket has suffered a lot. And if you put that basket together and look at the individual constituents, apart from India, the other markets haven't really performed, right? The bigger ones, which is Brazil, has been, so to speak, flattish for a while, went down a bit. The other part, which the bigger ones, which is China, and then, which was there, Russia, they have suffered extensive damage. So the bigger ones, in the scheme of things, they have suffered a lot. India has done relatively better. But as you said, when there is a basket selling, a lot of passive money flows, which when they exit, they don't differentiate a lot. Indian weightage in the overall emerging market basket is around 9%. So if there is $100 billion outflow from the emerging market as a whole, India also sees about 8 to 9 billion of outflow, and that is what we've seen. But when you look at the valuations differential, and if you were to do a MSCI India, price to earnings over a MSCI emerging market price to earnings, we are still trading at uh, almost the 95th percentile in terms of premium. Although it has gone down a bit, India continues to remain at premium, and we've always been at premium. So I think right now we are at the upper range of that premium, not because India has done something great, but the other markets have suffered extensive damage. So I see two things here. First is that emerging market as a whole pack has to be looked at from individual countries' point of view when you take the valuation call. But when you look at the flows, I think then the collective flows for emerging markets are probably going to turn around. I think that will happen, one, with de-escalation of this Russia-Ukraine issue, and second thing, market, when it starts to feel that the interest rate hikes and the tighter monetary policy is, when it starts to discount that. So these two factors put together will probably allow foreign funds to flow back into emerging markets, and that is a time where India will also enjoy healthier flows. I think the reasons for emerging market selling, or particularly India, the reasons for FPS to exit Indian stocks or sell Indian stocks, they have lesser reasons today than they had 3 to 6 months ago. So I guess the large volume of selling is already behind us.
Sahil, what does all of this mean for Indian equities? Not immediately in the short term, but medium to long term. Especially,
So,
growth we all know have been trimmed down for all over the
yeah,
world. India is not alone, but still, S&P, for example, yesterday said Indian growth above 7% perhaps would be the best in Asia. So we would
right.
actually be better off compared to many, but also in light of the downgrades, earning downgrades because of margin pressure, 2, 3, 4 quarter,
Yeah,
where does that bring Indian valuations?
sure. So first thing is that we need earnings growth over the next 3 to 4 years, because the kind of earnings growth we enjoyed in FY20 and 21, of course, it's not going to come back. FY22 is a little lower than what it was in FY21, and growth will be, I think, in the vicinity of 14-15% in FY23. That is what the market is expecting, and even after the downgrades, I think it is quite likely that we reach that number. So over the next 3 years, if we do 15% CAGR kind of a growth, Indian markets will continue to see an upward momentum. So to speak, the trend should continue in that fashion. And secondly, the downgrades that we've seen are coming from twofold. One is wherever the raw material pressure is high, we are seeing some downgrades, numbers getting trimmed, and that is most likely to continue for the next 2 quarters. We've seen a 6 months lag between raw material cost and then margin pressure coming through. So that most likely will continue for the next 2 weeks. But the bigger delta, I think, will come from the valuation multiples. So valuation multiples, which were at extremes. Nifty was trading at about 22 times a year forward earning about 6 months ago. That has gotten trimmed down to about less than 20 times now, largely because our interest rates have come back. Many across the globe, we've seen a normalization of interest rates. So you are seeing multiple derating to some extent, That will continue. I think probably another 100 or 200 basis points to go. Second thing is earnings growth. So if we are able to sustain 15% earning growth, which includes the downgrades that we are speaking about, we should be able to do fine. So if you put these two together, 2022 appears to be a year where you can get a lot of consolidation, move between the previous highs and the lows that we saw recently. So this kind of a consolidating, grinding move can continue for the next 2-3 quarters. And then probably based on the earnings growth trajectory, we move higher. So the underlying trend remains bullish on the upside, but 2022 provides a number of triggers for consolidation.
One quick last word. As we speak, cement prices have been hiked by 20 to 50 rupees a bag. A lot of companies are actually going ahead and passing on this margin pressure and protecting their earning visibility to a large extent. Some, of course, damage would be done to their demand as well. But how much probability would you assign that a multi-cap kind of approach with varying a blend of varying risk to their earnings reward coming together, a portfolio 15 to 18% CAGR on earnings front is conceivable over the next 3-year period, even adjusting for the downgrades? How much probability would you assign?
I think that it's a fairly good chance that we could do that kind of a number, because if you look at two basic trends, X of exports that we do globally, usually our earning growth. So you remove two things. One, you remove the export earnings, and second, if you remove any extraordinary items which are happening, we generally get closer to our nominal GDP growth. The nominal GDP growth has been depressed quite significantly over the next 2-3 years. I think we could do about 11 to 12%. So that kind of a base trend is already available. If inflation continues to remain 6% or so, we'll probably get higher top lines. But as you said, the bottom line is the main issue where raw material cost is going to get hit. But if you look at the overall earning pie, it is getting a huge amount of boost from those with supply commodities and also those exporters which make money outside. So I think it's a balanced approach from the full market capitalization point of view. We gain somewhere and we lose somewhere. On the totality, most likely markets will see this kind of a growth between 15% or so. I think 18% is too high. That is a number which probably we'll have to see many more triggers to happen. But 15 or under 15 is something which I think is possible.
All right, Sahil, always interesting chatting with you. Thanks so much for your time this afternoon
Thank you.
as well.